Hello, everybody. Welcome to the BuildDirect.com Technologies Business Breakdown. Before we get started, I just want to remind all participants the purpose of this presentation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Microcap Club is not a registered investment advisor. Microcap Club, its partners, its members, its subscribers, and affiliates may or may not hold positions in one or more of securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. I want to thank the Microcap Club community for tuning in to this business breakdowns conversation with Shawn Wilson, CEO of BuildDirect.com Technologies. I have Mark Zaray joining me. And Mark, say hi to everybody.
Hi, everyone. The T does get pronounced, Shawn, so it's Mark Zaret.
Zaret, sorry.
And I just want to also just mention, alongside with your disclaimer, I do work for a fund management company. One of those funds is long this particular security, and I think that's all. But other than that, just the usual. Anything I say is just my opinion and not a recommendation to buy.
All right, thanks, Mark. Mark has been an MCC member since September 2013, and Mark goes by MSZ on the club. And he profiled BuildDirect.com, ticker BILD.V, on September 18th, 23, before his pitch at the 2023 Microcap Club Summit. I'll just give a brief background. BuildDirect.com is a building materials retailer specializing in flooring. The company IPO'd on the TSX Venture Exchange in 2021 at $5.75 per share. Previous management applied the Amazon model, growing at all costs to connect customers and suppliers in an online marketplace. The stock fell to 20 cents per share in 2023. New management has now restructured the company, leveraging their brick-and-mortar stores to fulfill online orders more cost-effectively. BILD's turnaround has strong momentum under its new leadership with CEO Shawn Wilson and CFO Carrie Biggs, both seasoned executives with expertise to drive results. All right. Before we get into your presentation, Shawn, please share a bit on your background and what led you to getting involved with the company in 2022.
Yeah, I appreciate that very much. So on my end, I've been in the flooring industry for my entire career, so over 20 years. I started in major manufacturing, held roles at Mohawk Industries, which is the world's largest flooring manufacturer, in product development, sales, marketing, big box, so on and so forth. And a big part of that also was a consolidation play on the manufacturing side in the flooring industry. Really through the 2000s. From there, I spent time at Home Depot, where I built and launched the LifeProof brand, Home Depot's premier, still today, decor brand, and really had a passion for the end consumer and also what you could do with the flooring category with the right narratives and value offerings. From there, I started working on a handful of businesses that were consolidating flooring installation, a couple of turnarounds along the way. And for BuildDirect, a few years back, really saw this massive opportunity for a consolidation play with a specific model that we're going to go through here today. And BuildDirect for me was the perfect vehicle for that roll up. It had a massive presence already in the industry, an omnichannel presence, and also, candidly, the vehicle itself was in a good position for a turnaround and then be used for a roll-up. So that's the background of myself and kind of the starting point for the company under my watch.
Thanks, Shawn. Yeah, thanks for sharing your background, Shawn. Just a reminder to the audience, if you have a question during Shawn's presentation, feel free to ask by clicking the Q&A button at the bottom. We'll do our best to answer as many as we can at the end. Shawn, go ahead with your presentation.
Yep, sounds great. So as mentioned, we're focused on the North American market, and we'll talk about our pro centers really throughout the presentation. When we look at the market, first and foremost, it's sizable, but there's also a lot of adjacent categories, which is why we've maintained the brand BuildDirect. In our flooring locations, it's BuildDirect flooring, but when we look at our customer makeup and profile, that part will really start making sense. And so we look at our performance to date, our run rate's around 70 million. And then for us, really getting the company into a position of just consecutive positive EBITDA was great, and really kind of the starting point for us to make sure we had a solid platform for expansion. So the flooring industry is near and dear to my heart. So first off, it's a massive industry, over 90 billion, heavily fragmented. And typically when you think about flooring, it's tied to just traditional brick and mortar. It's not usually a category that is shopped heavily online, but a lot of that started changing. Home improvement also has kind of pigeonholed itself around a quarter of the space. And just by the nature of the categories they compete in, for example, at my time at Home Depot, it became very evident that this category is going to continue to really exist and thrive outside of that framework. And really from there, our major competition, if you want to grow and do big things in this space, are really regional and local mom and pop retailers. So first and foremost, that's the flooring industry as it sits today. Now, for the industry, just kind of going down a level deeper, there's a lot of great things about flooring. First off, it's a very stable industry. It's a required building material by a lot of building codes, and where it's not, it's required by lenders. And so, for example, you can't build a home, get a loan, so on and so forth, without having your flooring complete. And it's really driven day in, day out by the fact that you're walking over it, you're living on it, life happens, pets, all that kind of thing. But also you have a style trend. So you have this shift from beiges and browns and then grays to then accent colors. And so you have this kind of ongoing replacement that's being driven by both wear and tear, but also style. I love categories like that are required, but also have a very healthy base of residential remodeling work that really drives it. That's not a recent fad or trend, but just day in, day out, those stats have been there for quite a while. In addition to that, hard surfaces, which as the chart below shows are about half the business, it's mostly imported to North America for a few kind of basic reasons. From the wood perspective, like hardwood, which is a huge category in the industry and also for us, lighter colors are very fashionable. And for the most part, red oak comes from North America and white oak comes from Europe, meaning you're going to harvest and also refine and finish the products over there. And also same thing applies to tile, and also like on synthetics, laminated wood-looking flooring or vinyl plank-looking flooring. These products are manufactured overseas. And when you go back and think about who the competition is, these $2 to $5 million retailers, they're not importing from overseas. And so for companies like us, really BuildDirect, that's a huge advantage, really for us. And the last piece I mentioned, this category, although it's a building material, or required in many cases building material, it's narrative driven, story driven. There's a consumer journey that comes along with it. You can create brands and trends, and with that comes tremendous pricing opportunities. As we've demonstrated with our company, you can drive impressive margin opportunities from that. And that's a huge part of the category and thing that we're great at. So can I ask Shawn below the bottom right? This is a recent survey on the industry for retailers and what they do in their annualized volume. As you can see, it's heavily fragmented. So that's really for me why flooring and why I get excited about the category. So for us today, we're in pretty much every hard surface category with the exception of tile. Tile is an organic growth category that we will be layering in. We've already started piloting it online. We'll be layering it into our pro centers relatively soon. But we also provide other services for pros. And so things like, e-commerce services, quick delivery, specification, takeoffs, things like that. We have a very good platform built for that to really service those customers. I'm talking about the pro. I'm referring to what's on the screen here. So you have builders, tenant improvement, local mom and pop retailers represent about a third, for example, of our volume. We actually sell to those competitors as well. End projects, for us, it's all about being a provider of products and services to the industry. And we have different programs and tiers that we use with each group, from big box all the way down, to provide the right value offering for them. And so we are very much not pigeonholed into any specific segment, like, for example, just commercial or just new construction, but rather we keep ourselves just focused on B2B in one form or the other. And it's been worked out great for us. The marketing cost is quite low in that regard, and the model fits the customer very well. So with that, our team is focused very tightly on direct sourcing. As I mentioned before, in this industry in particular, that's a competitive moat for us, and it's an important one to really maintain. And then also, with that, we have a very disciplined approach. We view our company very straightforward, with a platform expense, a corporate function that's driving our e-commerce and our brick-and-mortar expansion, and the focus on doing such with high returns along the way has been a key focus for first our turnaround and now our expansion. So our pro centers we talk about quite a bit in our PRs, in our decks, and our materials, and today. And so if you think about a pro center, it's effectively a 15 to 40,000 square foot local center where we're doing e-commerce fulfillment for our BuildDirect.com business, as well as selling locally to a market, to contractors. So, like, as I'm talking right now, we have contractors, flooring installers, local flooring retailers, placing orders, picking up orders, getting advice on how to do an installation, getting help potentially with a customer who's having trouble deciding. We do just a lot of work for those customers. And for us, our primary growth strategy will be by expanding our pro center footprint, which I'll talk about here shortly. So today we have 9 locations. 8 of those are pro centers, and 1 is our e-commerce location, which is in Vancouver. And our run rate's around 70 million. We're just getting started. It's a massive TAM, as I've mentioned, and our run rate's pretty healthy off of literally just these locations. And then from here, this map, I want to just fill it in. 50, 75 pro centers just throughout North America is what I get really excited about. And the map is literally wide open for us. So when you look at our growth model, it really follows this flow. So we are an e-commerce first business, BuildDirect.com. You can go there and check out our offering. We enter in new markets through e-commerce. And so for the traffic, we have a pretty good mix of organic and also paid traffic. And we enter into new markets via e-commerce first. And that business in and of itself, that was a huge area we had to turn around with the team when we came in a few years ago. It's doing very well, very, very well. And we've used that effectively to just come in and provide that initial layer of customers, brand exposure, so on and so forth, to kind of skim a market. For example, like in Los Angeles, where we just launched a pro center, we first, about a year ago, started skimming that market with our e-commerce. And then although a consumer can buy on that website, for the most part, it's a pro customer or a consumer, a homeowner working with a pro. So that's how we enter into a market. Now we use that info to help identify the best locations for then building a pro center. Now for us, we have build and buy model. And so it's e-commerce first and then pro center second. And we establish that based on demand and also by just overall potential market, how we're gaining traction, And for us, as I mentioned, it's a pretty wide open map for all the major markets throughout North America. I'll talk a bit, more about building and buying here now. Like for us, building is relatively inexpensive because we start with e-commerce first to see the market. You have a base of a business that's built up, market presence. You could ramp up, much faster than if you're starting, from scratch. But in locations where it makes sense to buy, like let's say, for example, there's an existing business that's for the most part focused on the pro customer as well, and there's the right deal, the right structure. Then in those cases, we potentially have and will buy. But for us, it's just literally a math game on what option makes sense, because there's a lot of consolidation opportunities out there where, these businesses that, when we come to town, we're an aggressive competitor. They much rather just, sell out. We have a lot of leverage there in doing deals. And so when we do those, for the most part, we come in, we have some synergies that are pretty immediate on the procurement side because we're direct sourcing, products. But no matter if we're building or buying, we get excited about deals where our cash payback is sub 2 years. And that's really how we think about things. So in some cases, it could be, mostly inventory. Some cases it could be a bit less. We don't really think about things so much in just terms of multiple. It's literally just what we're buying, what we're getting, and what it means to us, which is the right approach for what we're doing, we believe. From there, it's all about ramping up. So look, Pro Center gets set up, doesn't cost a lot, or we build and we integrate, and we just focus on doing what we do day in and day out, very focused. And a very kind of stable play. And where it makes sense, we expand into installation services, which we've done now in a few markets, especially around the commercial side. Really from there, it's about just optimizing and integrating more and more on our locations, which we'll do kind of throughout. So it's a very simple, straightforward, and easy to model play. And so, for example, for us, announcements like, hey, we opened up a new location, or we bought and integrated a new location. It's just adding to those locations we have today. And they work together in regards to our e-commerce business, doing order fulfillment, so on and so forth. So to give you a very specific example, we announced this week a new location in Santa Fe Springs, California, which is a suburb of Los Angeles. With that facility now up and running, our e-commerce orders get fulfilled out of there. Dropped our fulfillment for e-commerce down by quite a bit in that local market, and it's omnichannel day one. Customers come in, look at samples, pick up orders, we ship out orders. Our delivery trucks run, orders to projects, pretty rapidly. And then from there allows us to continue to cluster. We do like cluster approaches. So for example, Southern California is a huge area. So the first Pro Center is step one, and then there's, of course, opportunity to expand in the market from there. Okay, so when you look at our past performance, a big part of what we were doing in the last few years was really working on EBITDA. We had, at that time, when I came in, an e-commerce business that was losing quite a bit of money and had a lot of fulfillment cost issues, which I've disclosed and talked about several times. And so, throughout the last few years, that was a huge part of our reorganization and also centralization of activities, which has really driven up EBITDA. And I would say there's still, from where this chart ends at the end of Q3 of 24, still a lot of room for improvement there. And for us, it's an important thing to make sure we maintain. I'm not really big on heavy corporate overhead. I like keeping the resources out in the operations. And for us, the primary synergy is procurement, which doesn't require a lot of overhead. So that's really been our track record and our focus over the last few years. We strategically brought down our revenue on the e-commerce side while we were getting that model fixed, re-geared up, fulfillment changed and improved. And then from there, have the ability now to start bringing it back up, which has been great. So our capital structure is one massive thing. I mentioned before, and I was looking for the right vehicle, the right team to go out and build this business with, was a huge draw for me personally to the company. So heavily held by inside ownership, very stable, great inside and very qualified inside investors and funds, a lot of support there as well. When I look at really where the company was when it first launched to really to the bottom when it just dove down, you know, a huge part of that was just a loss of a vision, a massive, you know, turnover in the management team. And then from there, the underlying, you know, intrinsic value for me was just phenomenal. It was like buying a house, opening the garage and finding a mint, you know, classic car in the garage, just needing to be pulled out and tuned up. This is how I felt about the structure. There was some debt on the company. Part of it was from, you know, past vendor takebacks, a little bit of old debt from Dean's Land, which was refinanced, and then Smith Center notes are used as bridge financing kind of between that time. When I look at comparables, so most of the comparables would actually be, you know, like for example, ABC Supply is a company that I just adore, a great company. They did a roll up in the roofing space, and you know, very much are similar. But from Pubco's side, these are some, you know, some decent, you know, comparables, especially when you look at, you know, Ferguson is a good example of having pro centers that are in the plumbing space, you know, tile shop, obviously, and floor and decor. Now, our model is built heavy for the pro customer, whereas like floor and decor is built for the homeowner. You know, there's a decent amount of pro business that, of course, flows through there, or even Sherwin-Williams, same thing there. They're paying pro centers is a similar example. So that's really where I think about us when we look at comparables. From a team perspective, really having a great co-pilot, yeah, you know, for our play was a huge piece for me. So adding Carrie to the team has been very impactful. Carrie came on, got our RBC facility put in place very quickly, very efficiently, along with really driving a lot of other operational improvements and changes as we've announced really since he has joined, which has been great. In addition to that, you know, from Rory to our GMs, you know, great solid team and a lot of experience in the industry and also experience in running plays like we're doing here. Lastly, I'll leave with the board members. These are the members of the family offices who also are substantial inside holders and very supportive. You know, and I really appreciate you know, the expertise and also the support along the way, especially doing a play like this where it's not a turnaround to flip, but a turnaround to build something spectacular. Having that solid base foundations, you know, pretty important. So for us to wrap up, huge TAM. We are a very aggressive and well structured competitor in this space. We are a very invested leadership team in more ways than one. Clear growth strategy, and then from there, you know, really for us, the turnaround on the vehicle has been complete. It's been great, and now from here it's just build. That's the plan. So that's the presentation for today.
All right. Thanks, Shawn, for sharing your presentation. I'll ask a few questions before passing it over to Mark. And again, just a reminder to our audience, click the Q&A button at the bottom. And if you have any questions, and we will try getting to that later on. So, Shawn, just a couple questions around the turnaround. What were the key challenges you identified when you took over leadership, and how did you prioritize tackling them?
Yeah, so I would say the first piece on the commerce side was having the right leader who had experience running homeowner e-commerce operations. And so we brought in Jay Allen, who is now our COO. And Jay ran a very aggressive turnaround in that business. There's a few main things they found and fixed. The first one was from a marketing strategy. Flooring is a discretionary category, and it's something people like to talk about, think about, so on and so forth. But what that means is if you use top of funnel marketing strategies, you will drive your marketing costs just through the roof. And so Jay, with that experience, you're really focused on a high intent marketing spend, which dramatically increased the per click cost, but also dramatically reduced at the same time the overall cost of marketing per sold order. So it was very counterintuitive to how the team was viewing it before. The second piece, which is a very important piece, flooring's heavy. It's a very heavy material relative to, to the price. And so the legacy model for the business was to use third-party warehouses for fulfillment. And the problem with that is your third-party warehouse is designed for small packages, things that you would ship and order off of Amazon, like, day in and day out, which, the team's background, was rooted in. But the problem with that is those facilities aren't built for heavy flooring. So you walk into a third-party warehouse and they have racks that go to the ceiling for all the small light items. Then the flooring being stored would be in an area and nothing above it. So the fulfillment cost on that online business was brought down, substantially. So for example, an average order of $3,500, it wouldn't be abnormal to have a fulfillment cost of $1,300 for that one order. And today it's closer to like $125. It's a huge shift when you do fulfillment yourself from pro centers that are geared and built to store things like it. Those are the two main things I would say on the e-commerce side that really created problems and challenges that were addressed and fixed by the team over time.
Awesome. And can you walk us through the most difficult decision you had to make during the turnaround process?
Yeah, the hardest decision was the reduction in the corporate team. So when you look at like the functions that the company had centralized over time, it was extremely redundant, and a lot of the functions candidly could be fixed through system enhancements and automation. So like one specific example, we had a very heavy tech stack that was custom built, very very much overbuilt, for what the business really was, and kind of in that legacy BuildDirect technologies kind of lens. But the industry had changed a lot. I mean, there's been a lot of advancements in e-commerce and in ERPs, CRMs, so on and so forth, in both our industry and also industry in general. And so just going with streamlined systems, reducing complexity kind of along the way. Look, it's a tough decision to make, but it made us remarkably more competitive and allowed us to scale in a much better way. Definitely probably the hardest call, which it is really for any turnaround typically.
All right. I think that's good for me for now. So I'll pass it over to Mark.
Thanks, Shawn. So as investors, we learn to try and identify what edge we might have when we're making our decisions. And so I look at BuildDirect and I say, Shawn, what is your edge? In other words, you briefly touched on sustainable or competitive advantage, I believe, but what's your sustainable competitive advantage that you could talk about?
Yeah, so say a couple of things here. First off, in the flooring industry, this is something that you really learn by spending a lot of time in it. You learn that it's a business that's built off a lot of potential channel conflict issues and models that have a lot of weakness to them. So I'll give you an example. There are a lot of distributors who have like single source suppliers and contracts built that way. So it might be a $200 million distributor of some sort, but it's effectively an outlet for a manufacturing plant. Or you have a business that's literally built to just service new construction. So like the entire model, everything about it's built, for that cash cycle, so on and so forth, is built towards that. So over time, with the cyclicality of the business, like you see these the ramifications of these decisions and the weakness it creates, and great companies just tumbling. So for us, that was a huge part coming into it. BuildDirect had a very much they don't have a lot of strong segmentation positioning, and for us, that's a huge part of it. So like our specification business is very abnormal. They process renovation specifications, new build, commercial development as easy as restoration. Everything has been built for the pro, but not really geared into a specific subsegment. And so for us, we're able to ebb and flow pretty fast. Like last year, for example, the industry had a tough time with interest rates, but we definitely outperformed our industry industry peers, really with that. So I would say one of the first things we have is we have a business that is free and unencumbered from a lot of those legacy things that drag down, in particular, this industry. And then with that, I would say, look, from a legacy perspective, BuildDirect has a great brand, been around for a long time. Our marketing spend on our e-commerce side is highly efficient, but it's highly efficient from 20 years of demand generation and organic traffic, things like that, which would make it makes it very difficult to replicate. It's not cost effective, in other words, to replicate that. You couldn't spend enough to make it efficient in a fast enough time. So those are probably two big areas that I would say really help us stand out, that are contextual within the industry.
Okay, thanks. Well, one subject that's on a lot of investors' minds right now, especially Canadian, is the whole issue of tariffs. And you're a Canadian company with U.S. operations, probably buying in a variety of ways. Can you expand or tell us a little bit about whether or not tariffs is an issue for you at all?
Yeah, so this one definitely hits close to home for a lot of folks. I was literally speaking with a distributor yesterday. Obviously, I won't name. Beautiful company, lots of volume, great brand. Everything was great. Single source supplier, and they got hit. The country that they're sourcing from got hit, and it's what do you do, right? So for us, tariffs have had really two big impacts. In a lot of regards, have been positive. So the first one I'd mention is, a few years back, kind of the first big wave. A lot of the legacy importers were importing from China, and when the tariffs hit, that supply chain broke. A lot of companies, moved manufacturing or incremental manufacturing to other countries such as Thailand, Vietnam, Cambodia, so on and so forth. And so that did two things. First off, it created artificial supply. It wasn't supply driven by demand. It was supply driven by, trying to avoid tariffs, finding a different path. And so that really enabled, folks like us who are set up to import very effectively, especially an industry that's not used to doing it, helped us out quite a bit because you have a lot of artificial, beefed up supply without the demand. So a lot of people would think, hey, that would probably suppress price. Sure, if there wasn't an ocean in between and all the complexities of importing. The second thing I would say, we've been very, very cautious. We don't like concentration. If that hasn't come across yet, we don't like concentration in customers, segments, nor supply. And so for us, we're very intentional about having a very mixed group of suppliers. And on the product side, we're very cautious on not building our brands based on manufacturer-driven specifications. Rather, we do that, and then we find the factory. And so if country one gets hit, country two is already online, and we just move over the reorder. And that's how we, how we're really, viewing tariffs. And so will there be some complexities along the way? Sure. Those things definitely happen, but I do believe we're very well positioned and will likely be able to take advantage of the kind of the quasi chaos that's happening.
Thanks, Shawn. So you have two primary ways that you're going to grow the business. That is to build or to buy. I don't know, perhaps you can expand a little bit more on the pros and cons of each one. And I've got some sort of questions that would align with that, but if you could start with that, and then I've got some follow-up.
Yeah, sounds good. So like from like an internal team perspective and just how I usually address the company, for us, our e-commerce business is scaling back up now that it's, reset, great model, makes money, so on and so forth. So for us, the main growth is just ramping up pro centers. We have 8 pro centers today. We want to have 50 to 75 just throughout North America. And with that, it's a build and buy. We're entering in the market with e-commerce, and then from there, the next expression of service, next level of service is a pro center. So on the build side, it's great. Come in, hire a fresh team, existing systems, our inventory. So our investment of the around 750 I mentioned before is mostly inventory. On the OpEx side, it's very light, very inexpensive to get the buildings in shape for how we use them. Like we're a fantastic renter in that regard, and so we get a lot of concessions there on the build out. But really from there, like it's a ramp up period, right? So the ramp up of building up that base of business, so on and so forth, with the local market. If we're buying a location, it just needs to make sense, because you typically have an industry ERP that we can plug into our corporate ERP, but we prefer to align them. So there's a bit of that work we have to do. Not a lot of expense, just more of a phasing it in from a people and process perspective. And then also on the procurement side, we buy very well. We buy very, very well. This is coming from someone who's a former Home Depot merchant. BuildDirect buys very, very great. And so it's very unusual for us to buy, a book of inventory from another company and look at it and say it was bought as well as ours. And so for us, we're very mindful in that regard. So when we're doing an evaluation on the business, we're not looking at the dollars of the inventory. We know what we're buying. We can trace it back to where it was made almost all the time. And we have a point of view of what that gap is for us if we buy that inventory, and then what it would be on the other side of it very quickly. And so that's how we approach the build and buy kind of decision. Now, for us, like we look at the business as like, look, we have a great brand. We know what we're doing. We have a great marketing function. And if we come into a market, is there a ramp up period? Sure. If we bought a business that has, an active 100, 200, pros actively buying, then fantastic, right? We can, leverage that quite a bit, but it needs to make sense, so it's effectively, we look at it from a perspective of what assets we're buying, like, racking, the inventory, which will eventually turn over and consolidate, so on and so forth. And I go back to, it's for us a math equation, where it makes sense. There's nothing that we're buying that we couldn't just build. And so that alternative for us, everything's constantly compared to build. So last kind of saying this probably the same way a few different times, but there's no deal we do where the comparative analysis is not on what would it be if we built that in that area.
I'm just curious, actually, like when you're going to be buying and you're buying inventory, how do you go about assessing whether you're buying stale inventory or not? I mean, that's, to me, would be the one big risk in that approach. How complicated is that process?
So herein lies one of the biggest opportunities in the industry, and something I get really, this is like a nerdy topic I get really excited about. I spent a lot of time in product management at Mohawk. So for flooring, not a lot changes, like with style and design over time. You have a lot of consistency, but a lot of a lot of companies get bored of their assortment before their customers do, right? Like, so, for us, we look at inventory with a couple of different approaches. First and foremost, it's actually not age. You could have inventory that was brought in a month ago that has less value to us than inventory that was brought in 2 years ago where you just ordered too much. The most important thing is that inventory represented by a forward-placed sampling marketing program? Because in the flooring industry, what happens, and where you can really get yourself in a bad spot, is you can have inventory that's great inventory, but it no longer is in samples that are deployed with your customers. So a pro customer, you can't change the assortment day in and day out. You have to be very consistent. That's the first thing we look for. Okay, we have the inventory down to the SKU. What is the sample placement like in the field? And we do validation that's there, active. And if there are bloats of inventory, is it tied to this being missing or bad ordering practices? We very quickly find it's typically the former, where let's just say, for example, 50 SKUs were brought in, and those 50 SKUs had sample displays, merchandising, marketing that are no longer in the marketplace. Now, for us, one massive advantage for that is we have our e-commerce business, and we can load up products as fast as we can take them down. It's very, very quick. And so for us, we're able to maximize the value from that for that. The number of calls we get from distributors, manufacturers, asking for help to clearance out what I just described as like dead inventory that's great, but not tied to a marketing program, it's almost comical. And so that's one massive advantage that we have. And it's very hard to replicate based on the 20 years of demand gen and organic traffic building, things like that. So that's probably the first and foremost thing. The second is I would mention, we obviously do our audits, check for quality, so on and so forth. But also for us, we do an evaluation based off of what something is worth in the marketplace versus what the book value purely is. And sometimes, you find a benefit there, and sometimes, the opposite. So because that's primarily what we're like the majority of the substance, what we're interested in buying, that's how our team does the evaluation.
Okay, thanks. Maybe we could move to a little bit more about the capital need, let's say the need for capital. I know you have a bit of a runway right now with some debt, but it strikes me that at some point you'll likely be looking to raise capital. And if I could just interject here for a minute, when I very first looked at the company and I looked at the quality of insider and I looked at their ownership, it struck me that they could have easily just taken this company private for pennies at a certain point, I think in 2023, but they chose not to. They in fact chose to do a small financing, which gave me some comfort in the fact that they wanted this to be a listed company. They wanted to continue, as a public company. But the primary advantage of doing that, of course, is at some point to use your shares as a currency. So I guess I'm sort of curious around the whole issue of your need for capital. At what point do you think you might expand the shareholder base? And ultimately, it seems that that's how you'll grow this into a much bigger company.
Yeah, no, it's a great question. So so I'll say kind of a few things to provide a view there. So kind of first and foremost, we look at what we want to build. It's not, at least it's not 10 or 20 pro centers. It's something, far greater. The opportunities there, the ambition, and also, really I believe the skill set, like we'll definitely have a great time doing it. But with that, there's a series of things that need to happen. So for example, the company had been around for a long time, but never really had a good financing partner. So, for us, really, slowing down and getting our facility in place with the Tier 1 bank, RBC, with the support from the Economic Development Canada. It's a great organization for businesses like ours. You're really getting the facilities put in place that allow you to have that long-term build versus chasing capital and trying to get over your skis, or not trying, but that happening kind of inadvertently wasn't just something that we weren't interested in doing. And then to your point with the insiders, 100% demonstrated, really the quality of character on that front, on how that bridge financing was done during the point of what it is, management, crisis/turnover, which required a new team to come in. And for me, I saw the same thing, Mark, when I was talking with the board and insiders, really early on. I think that's probably my third question I asked at dinner that night. And the short answer was it's not the right thing to do. In a lot of regards, and for me, character, reputation, especially in the space that we're in, means a lot, right? So I would say that's definitely a very genuine kind of point of view there. They're also big funds, right? The Mark Anthony Volcanis Group, substantial fund, BD Capital substantial, or Growth substantial. These are pretty big investors, and so you have the both the willingness and the ability of doing really doing the right thing there. I would say on the equity side, short answer is no. I don't like companies that require raising capital. Just my point of view and how I like to operate. It's not really a thing. And so I like having businesses that can cover their own obligations. But when it comes to growth, we also have a very measured approach in view of what the ratios need to be to make sure we can maintain great terms on the debt side and to build this responsibly. We can have a tremendous run of extremely accretive growth, very accretive growth, without getting greedy. A saying I use sometimes internally is pigs get fat, hogs get slaughtered. I was in Georgia for 8 years, so I got that from there at some point. That's how we view the debt and equity deal. So for us, having operations that take care of themselves is first and foremost a required deal for myself, Carrie, and the team. But then also using equity in a very accretive way as we build up to make sure we maintain the right and reasonable ratios is very important.
Okay, thanks. I'm not sure if you have questions in the queue, Shawn, but I'll just ask one very quick last one. Have you got plans to list in the States, to open it up to a wider potential investor community? I think the only listing in the States right now is Pink Sheet, which is a little bit of a difficult market. Any views to expand your listing?
Yeah, the short answer is yes. We're primarily operating in the States. We're very interested in doing more in Canada as well. But we're actually very well known both within the industry and a few other regards in the States. And so that is something that makes a lot of intuitive sense. And then for us, it was a matter of just an order of operations. So first get EBITDA in a great spot, get the right team put in place, get the going concern dropped from the company, which was a great milestone, get the Tier 1 bank set in place. And then intuitively before that, had the right CFO and finance team put in place. And so now we're just marching through those steps. And so yeah, the short answer I mentioned, I would say is, opening it up makes a whole lot of sense, and is something that will be interesting, right? Because especially within like the flooring industry and adjacent industries, people like to bet on companies who are in their space, even if they're quasi competitors. But yeah, being on the TSXV and not having an easy path to purchase stock, for the US side who likes it to be nice and easy, which is no harm, no foul there is important. I'd mention also I'm primarily based in the U.S. as well. It's where I live, where I'm at most of the time. Most of our team is here as well. So intuitively, that's how we are approaching things.
Okay, thanks,
Great.
Shawn.
All right, so I think we have about 10 minutes before we need to hard stop it for Shawn. But a couple audience questions. Can you run us through the economics of transactions you are seeing currently to acquire mom and pop centers to get a sense of the IRRs?
Yeah, so I'll walk through like just like a hypothetical example, and you can kind of scale this up or scale it down. You know, for us, we look at like a pro center, what we would convert to a pro center. It's like a mom and pop, you know, version of that. Let's just use for easy math. Let's say it does $10 million in revenue. EBITDA for that business is pretty close to cash flow. There's not a lot of noise in there. So let's say it's at 7.5%. It's a pretty good number to use. Gross margins based on that, we're probably around 30-ish or just under 30% in that range. And that business probably has a you know, inventory position probably close to about probably about 1.25 to 1.5 million. Roughly in AR and AP are you know, for the most part will probably wash each other out. So for us, you know, with the business like that, like, you know, our starting point is, you know, is probably like in the 1.25 or 1.5 range. That's, you know, like from an intangible perspective, 10 or 15% kind of makes sense, you know, for me, because, you know, you have my comment before about inventory and how we tend to buy a lot better. And so, you know, for us, that's kind of how you would model that out. The thing I'd mention though is there's a difference between what we can buy and what we will buy. So in our due diligence, you know, work, we literally take what's being bought, what's there, and we pre-quantify the synergies on procurement, not broadly like, oh, they buy, you know, carpet for an average price of $10, our average price is $9. No, we're a strategic competitor. It's literally the sheets, the manufacturers, where it's sourced from, everything, all that work is done. That to me is what I call quality due diligence in the space. And we quantify that, and raising EBITDA post-transaction to, you know, 10 or 12% is very feasible off of like that. We don't really look at it from the perspective of like operational synergies. Like for me to do a deal, it has to be worth a heck of a lot more than the cost of saving like an accountant or like one person here or there. And so that's like the big swings that we would take. And when you're kind of modeling out the IRR, that's kind of where, you know, where we get excited. I mentioned before when we're at a 2-year, you know, kind of a 2-year, you know, cap or payback. And that's, you know, literally just, you know, factoring that one synergy that we quantify.
One last one. With the high IRRs, why hasn't private equity already created a platform to roll up this space? If they've have they tried? Has it gone wrong? Like what are your thoughts on that?
It has gone wrong. Yeah, it has gone wrong. I won't name any names on this call, but so there was like 2 other big, like few years ago, like the phone's ringing. I mentioned before, 20 years of cocktail parties, meet a lot of people. And you know, when I was 30, they were in their, you know, mid 50s. Now just fast forward, you know, 10 or few, you know, so years, everyone's in a different stage. The phone rings. So there's 2 big things that happen. So first off, these businesses have a lot of inventory typically, which means they're located in commercial real estate, which means they probably own the real estate. Like 9 out of 10 own the real estate. It's very, very common for us. And so first off, their big payoff is not the business. It's, you know, the $20 million they're picking up in the real estate. So that's the first big thing I would say. The second is when you look at private equity in this space, they've done well or better on businesses that have very low inventory, a lot higher AR, and are segment focused. Like for example, on new construction or a commercial, there's been a couple of PE roll-ups in that space. But the trouble is, I mentioned before, there's a cycle, for those, especially on the new construction side. And so there's activity happening there in private equity, more power to them, doing a great job. We're not interested in that at all. We're interested in the businesses that are heavily diversified. And when it comes to inventory, as I mentioned, when private equity comes in and they're buying that book of inventory, there's no outlet. There's no outlet. And so you're not, there's not really a synergy in procurement, because like those folks would be buying from people like us. And there's not a way of maximizing value through their outlets. And so that's been one area when we do deals, the competing, party is typically just time. It's not like there's a PE, counterparty, trying to negotiate a tighter deal. And, frankly, I'm not trying to sound, too, cavalier, but it's fantastic coming in after there's a fallout from that. And so that's what I would say in the space that we're in. The two big things that I really noticed that got me really excited is, like, geez Louise, there's not buyers for these businesses. And the reason why is, within a strategic perspective, we can drive massive improvements, and we have outlets for that inventory to reconcile it. And so because of that, like, let the building, let the real estate be the big payoff, and the business becomes a lot more obtainable.
How about one quick more question? What's your goal for 5 years out? Is it 50 pro centers, or is it maybe a little bit lower because you keep throwing out the 50 to 75 number?
Yeah, we'll see. I mean, it's all about, for us, it's all about, yeah, I'd be very happy with that. I'd be very happy with that.
And what does the business look like at scale, at that type of scale?
Yeah, so if you kind of look at our business, really, this year, Q1 going forward, Carrie's done a great job and the team's done a great job helping to separate out our financials, make it very clear. So corporate platform, the entity that's really required for this play, and then the pro centers, and how they how they run. So I would say, like, if you were to look at that business, your platform, so your operations are, probably in like the 12 to 50% EBITDA range. Not guidance, obviously, just that's how those businesses will look like. And from a platform perspective, very conservative. There's not much required. As I mentioned before, our only real main synergy that we handle is procurement. And that's really it. So, like, at that range, I'd be thrilled if we were, like, for me, what gets me excited is a $500 million business in this space, which is very obtainable, in my opinion. And a business that's having an EBITDA of around like 15%, makes me excited in this space. Building to there isn't super complicated. The important part is doing it the right way, the capital efficient way. And first and foremost, our team thinks about capital allocation quite a bit. So we don't get excited over a massive big deal as much as we do doing a deal the right way. That makes sense.
Thanks everyone for tuning in to this Business Breakdowns with BuildDirect. Until next time, thanks again, everybody.
Thank you.
Yeah,
Thanks.
bye-bye.
Bye.